Before we get started, I want to start with a safety announcement. We have a safety announcement for any large event. Before we begin, when we have public events, we start with a little bit of a safety announcement. I'm the responsible safety officer for today, so if anything happens, please follow my instructions. The exits are right in front of us, and the emergency escape is down right on that corner, and we'll go outside and meet across the street, so please follow me if we have to do something. So I had to do that, so just please listen if there is an issue. I highly doubt there will be. I want to first thank my very good friend, Michael Levitt. This was Michael's idea. Thank you, Michael, for suggesting this. Michael's on the SEAF board. Michael's been a longtime friend and colleague, and Michael is also an affiliate here at CSIS, and he said 6 months ago, we have to do this. And so when we got 450 RSVPs, I said, okay, Michael, you're right. Thank you. I want to also thank Charles Rice and Connor Savoy for working very hard to help pull this all together. A number of people have made trips in from New York and from Boston to be here. I want to particularly thank all those folks who've traveled a bit to be here, so thank you very, very much. Okay, so international development is in the midst of a period of change. I think if you read any of the stuff that we talk about here or work on here at CSIS, I think we're always interested in sort of what's the future of development, how can governments, how can other actors make a difference in a changing global context, especially in emerging markets and in developing countries. We've done quite a lot of work on the role of the private sector in development. I think this conversation about impact investing is particularly appropriate. We were having a conversation earlier today, and I think if we had had this discussion 10 years ago, we'd have had 10, 20, maybe 50 people who were sort of finance specialists. And I can remember being at meetings that size when I was at IFC in 2007 or 2008. And it was sort of an obscure group of folks working on it. I think if we'd had this meeting 5 years ago, we might have gotten 150 people to come to something like this. I think the fact that this is sort of this has now become a thing. And so I think I think it speaks to a number of different changes in the world. I think some of the other things to note, if you look at the new Sustainable Development Goals, there's a lot of language and energy, both in the Sustainable Development Goals, but also in the communique, the Addis Ababa communique on financing for development. A lot of language about the role of the private sector, so I think this also fits into that discussion as well. So I think, and there's all sorts of numbers. I think you'll hear about them today. There's been a number of studies about the size of the impact investing market, the role of different actors, whether it's philanthropy or the private sector, as well as DFIs, development finance institutions, or actual players in the official development assistance space, organizations like USAID or the World Bank itself, or other bilateral donors, whether it be the Australian government or DFID in the UK or others. So we're very fortunate. I've asked Alan Murray, who's the editor of Fortune magazine, to begin the day. So really appreciate you coming down, Alan. Thank you very much. Alan has served as the president of the Pew Research Center and as deputy managing editor and Washington bureau chief of the Wall Street Journal. Most of his career has been in Washington, so I think it's really, really great that we have Alan to be with us. He's also a member of the New York Economic Club and the Council on Foreign Relations. And I think you'll get a sense of why Alan has made the trip down from New York. He was on the board of SEAF, and so also brings that as well. So Alan, without any further ado, I'm going to ask you to come up. Thank you very much. Please join me in welcoming Alan Murray.
Thank you.
Thanks a lot. Thank you.
Thank you, Dan, for that very nice introduction. I'm going to stand up here because it makes me feel taller. And I really, wow, I'm amazed actually by the audience that's here this morning. I'm a journalist. I've been a journalist my whole life. I started a newspaper when I was 9 years old. It's kind of what I do. And as a journalist, it's my job to know a little bit about a lot of things, but not a lot about much of anything. And so I am not an impact investing expert, but the good news is you have a whole 2 panels filled with people who know 10 times as much about impact investing as I do. So you're going to have plenty of time this morning to hear from the experts. And I've taken a look at the audience list as well. There are plenty of people out there who know a lot of impact investing. But why I wanted to be here is because I believe, as a journalist, I see this as part of a bigger picture of something that is going on that I deal with on almost a daily basis. And I'm convinced it's real, and I'm convinced it's a big change. And I think the fact that so many of you came out this morning in the cold to listen to this discussion is one more piece of evidence that there is something going on in the environment out there that's very significant and very important and very different. And it's not impact investing per se. As Dan said, I got a call 25 years ago, Bert, from Bert Vandervaart asking me if I would come on the board of this crazy organization that CARE was creating, that was the forerunner to SEAF. So impact investing has been around for a long, long time. But I think the environment that it's operating in right now is different, has changed, and means that we're on the cusp of something very significant. So I want to just take a few minutes before we start to paint that larger picture as I see it. And part of it, probably the first thing to mention is the kind of backlash to capitalism that we are dealing with today that has really sprung up in the wake of the financial crisis of 2007 and 2008, which called into question the system and the way the system works, but also caused people to focus more on the growing inequality that is happening in developed nations. And if you have any doubt that there is a backlash against capitalism, I would urge you this weekend to go up to New Hampshire and attend a Bernie Sanders rally, and you'll know what I'm talking about. I mean, it is remarkable that we are sitting here in 2016, 25 years after the collapse of communism, following an extraordinary 2 decades where we had the greatest alleviation of poverty in the history of the world because the Chinese government explicitly embraced capitalism, that we are dealing with a situation where we have an avowedly socialist candidate who has a decent shot at winning the Iowa and New Hampshire primaries. So it's an amazing thing. And it's not just in the US, obviously. You hear it from the Pope, Pope Francis. I mean, if you follow what Pope Francis has been saying, particularly the comments he made when he was in Latin America, it's a little less boisterous than Bernie Sanders, but the message is not that different. And you hear it from the capitalists themselves. I mean, one of the interesting things going on is all this talk if you listen to Bill Gates was one of the first, started talking about creative capitalism 6 or 7 years ago. You have people like Mark Benioff, the CEO of Salesforce, talking about compassionate capitalism. John Mackey, the CEO of Whole Foods, talking about conscious capitalism. Michael Porter up at the Harvard Business School, shared value capitalism. And I'm missing some. Lady Rothschild has convened 2 conferences in the last 2 years about inclusive capitalism. So there's something, everybody seems to feel the need to put a modifier in front of capitalism. There is a sense that the system isn't working as well as it should, and it needs to work better. And I think that's part of the broader context that this conversation is taking place in. The other thing, of course, is just the ineffectiveness of governments to address so many big problems. And we feel that particularly here in Washington. Look, I spent most of my career in Washington. I feel like, to some extent, it was a downhill, a 3-decade downhill slide in the ability to get people of goodwill from both parties together to address major problems. When I graduated from college a long, long time ago, people who wanted to change the world, their first impulse was to come to Washington to join government. That's not the way my kids think about it, because they look at what's going on here and say, well, geez, what big problems are getting solved by government? And of course, it's not just in the US, it's not just in Washington. There are questions about the efficacy of government organizations around the world. And I think there's been some of that with traditional charities as well. An awful lot of money has been spent with the best of intentions, but frequently the impact has not been sustainable. And so it's the combination of the questions about the basic structure of capitalism, but the lack of a decent alternative that has led to this conversation about how do we use the powerful tools of the market in order to have an impact on the big, gnarly problems that we know the world is dealing with today. I also think there's been a major change in the nature of leadership that is part of the reason you're hearing more about this from the people who run large corporations and investment funds and so forth. And one of the best books, probably the best book I read last year was Moises Naim's The End of Power. I don't know how, show of hands if any of you. So some of you are familiar with it. Those of you who haven't read it, I would urge you to read it. It's a very smart analysis of how social trends are really undermining the traditional levers of power in our society. And that goes for economic corporate power as well as political power. And he goes through a number of reasons for that. Part of it is the democratization of information. Power, once upon a time, was the ability to control or to hold or to know the information. The people at the top had the best access to information. Today, everybody has access to that information. It's available readily. And so both the good and the bad quickly becomes widely known. It makes it harder to exercise power. By power, he's talking about the ability to get people to do things that they might not otherwise have done. And communication is a big piece of it. The fact that somebody can stand in Tahrir Square and have as much impact as the leader of a nation is clearly something different than existed 20 or 30 years ago. So social media, the ability to rally people quickly around an idea or a cause. And I think what I see in my daily life at Fortune magazine, what that means is that if you want people to follow you, if you want to lead people, you have to make them want to follow you. And so moral leadership becomes more important. You have to give them a cause, a reason to rally around. And I think that's really significant, and I see it regularly in the conversations. You look at, even 10 years ago, corporate leaders were afraid to talk out about social issues because they said, hey, that doesn't affect my bottom line, and I don't want to get involved in something controversial, so don't ask me to weigh in on, well, the big example in the last year was government laws about same-sex benefits and rights within states, the number of corporate leaders who got involved to beat that back in Indiana and so forth. But there are many other examples. At Fortune, we just this year, for the first time, started something we're calling the Change the World list. We have a lot of lists. We have the Fortune 500, obviously. We have 100 best companies to work for. But we thought what was missing was companies that, with intentionality, are looking to address major problems as a key part, major social problems, major global problems, as a key part of their strategy. This isn't just CSR. This isn't corporate charity. This is companies saying, we can do good in the world and do well as a company at the same time. So some of the examples on that list, what Vodafone has done in working with Safaricom in Kenya to remake the financial system around cell phones, what Danone is doing, putting micronutrients in some of its products to help address undernourishment in the third world. There are a host of examples, and they're really compelling and they're really interesting, and I believe they are. It's not that some of these things haven't always gone on, but there is more focus on it today than there has ever been in the past. And some of that is driven by self-interest. I mean, one interesting anecdote, in the last year, I've had conversations with people from Koch Industries, Mars, and Bechtel, which are the three most secretive big companies in the country. I mean, in the past, as a journalist, I can tell you, if you tried to get a story, you tried to get them to talk to you, they say, forget it, we don't talk to the press. We don't want anybody to know what we're doing. In the last year, I've been approached by people from all three organizations saying, we want to get some publicity. I said, wait a minute, you've never wanted publicity. Why are you now asking me for publicity? In each case, the answer was the same. We have to get our story out there. We have to tell people we're doing good things in the world because they will come to work for us if we don't. And that gets to another piece of the puzzle, which I think is generational. I spent a couple of years before I started at Fortune running the Pew Research Center, and during that time we did some look at millennial attitudes. I think a lot of what people say these days about millennials is probably overblown, but there are some things that are very different about this generation at this age from previous generations at this age. they have fewer affiliations. They're less likely to be married. They're less likely to belong to or participate in organized religion. They aren't joiners. They don't have the social affiliations. And one of the things that means is that the economic affiliation, their work, is their key connection to society. And so whereas previous generations might have thought about their efforts to do well, to make a living, support their family, et cetera, and their efforts to do good, to have a purpose, to justify their existence on this earth, they might have separated those into separate boxes. This generation puts them together. And you can see it in the polls. They want to do well and do good at the same time. And so I think that's also another piece of what's going on. There is a generational change that is driving the desire to use capitalism for broader impact. And then finally, there's just, we were talking about this backstage, there's the availability of money. There is capital. I mean, one of the effects of the inequality that I was talking about earlier is that there are concentrations, huge concentrations of capital. Ben Bernanke talked about the savings glut. There frankly is more money out there than can be productively put to use. And I think that's part of what's going on here as well. You have a lot of people sitting on pools of money thinking about, what do I do with this? The economic returns, particularly in a zero interest rate environment, aren't that great. And so there's more focus on, can we use this money to have a positive impact on the world? Can I use this money to affect positive change and to make the world a better place? Can I change the world? So I think if you put all that together, you're dealing with a very different environment today than you would have seen 10 years ago or than you would have seen 20 years ago. So I'm really glad to be a part of this today. I'm glad we have such great panelists. I'm glad so many of you are here. As Dan said, I spent most of my career, I'll just say this finally, I did spend most of my career here in Washington, close to 3 decades. And so I've been to more than my fair share of think tank conferences. And I have to say, after a while, I got a little bit jaded. You would walk out of a conference on healthcare or energy or finance and say, really? We're having that discussion again? One more time? This is not one of those discussions. There's something very different going on today, and it's a good thing, and it's something that we should celebrate. And I thank all the panelists for being part of the conversation, and I thank all of you for being a part of the conversation. I think it is a good sign for the future of our society. So thank you, Dan. Do you want me to just go ahead and this is, I'm going to moderate the first panel. I'm delighted to do it. Amie, good to see you. So let me introduce them quickly to you. There's a wide variety of expertise sitting up here with me. Amie Patel, sitting to my left, is the Vice President of Goldman Sachs Asset Management. She joined Goldman Sachs through the acquisition of Imprint Capital, if I understand it correctly. Before that, you worked with the Soros Economic Development Fund, so have a great deal of experience in this area. Next to her is Ambassador John Simon, and I have all my notes right here, founding partner of Total Impact, which is also an impact investor, and before that, U.S. Ambassador to the African Union, and Executive Vice President of OPIC. Yes. So again, great deal of experience in this area. Next to him, David Wilton, the Managing Director of Morgan Stanley Alternative Investment Partners. And before Morgan Stanley was with the IFC, which I guess we can refer to as the original impact investor. Would that be fair?
Possibly.
And then Bert van der Vaart, who is also a pioneer in this area. He was the co-founder of SEAF way back in 1989, established their first fund in Poland in the early 1990s, and is now CEO, and that was after escaping his successful career as a lawyer. So thank you all for being here, and the way I'd like to start is just to ask each of you to talk about what you see happening in this impact investment area. You may briefly want to define what you mean by impact investing and what you see in this area and what you think is driving it. And we'll give each of you a couple of minutes to do that, and then we'll have a conversation. Who wants to go first? Amie? Sorry to put you on the spot,
okay.
but you're closest.
Thank you for the opportunity to speak. So clearly with the acquisition of our firm, Imprint Capital, there is a large institution seeing demand driven from their client base. Institutional investors, pensions, foundations, high net worths, family offices, et cetera. And instead of trying to build the DNA in-house of how to assess ESG and impact, they felt that it was more prudent to go out to the market to find a team that could bring in that expertise in-house and help them expand their product offering, their manager selection, and really thinking about creating diversified portfolios of ESG and impact investments. And so we collectively see a huge opportunity, a growing demand, interest, curiosity as to what is this space, what does it mean, and a lot of people needing help unpacking the terminology, the ways in which one can invest across the variety of asset classes. And so the way that we have been helping our client base define impact investing is really looking at it across the spectrum. On one end of the spectrum, you have values-based alignment, sort of an SRI screening, and on the other end of the spectrum, you have philanthropic donation, grant giving. And in between...
I'm sorry, can you just describe the left-hand side, the
Sure.
first side of the spectrum first?
Sure, so values-based investing, really just screening out things that you wouldn't want in your portfolio. More
Kind of a negative screen.
Negative screen.
We're not going to do oil companies.
Exactly.
Yeah.
And then as you've seen over time, that thesis has evolved into a little bit more of an active and passive strategy within ESG, within the public markets, really thinking about excluding certain bigger themes, not carbon neutral trading, more sustainable supply chains, more eco-friendly companies within those portfolios, and really thinking about how to create alpha through manager selection, and thinking about what comprises within that ESG framework, and what are all the components that you would want as an investor.
And is this driven, we'll get to you, John, I promise, but is this driven by investor demand, or is it because this is what you want to do?
What we want to do, or what?
Yeah, what's driving it?
What's driving it? I think it's, Imprint wants to do this.
Right.
And then Goldman there was an equal desire of wanting to experiment more into this space, and demand from its client base, wanting to understand how to create a portfolio of ESG assets.
Yeah.
As you go along the spectrum, I'll be quick.
Yep.
You think about impact investing, there's ESG coming into the private markets, assessing a fund manager or a private opportunity across ESG. We think of that as a corporate analysis, and then there's a more directed impact analysis where you are specifically identifying a tangible, measurable impact that you can create within society. So carbon neutral, or creating CO2 savings, or creating a certain number of jobs, or increasing financial access, something that's very tangible through the intervention of that capital that can be measured over time.
And you're trying to operate on the entire spectrum.
We do operate on the entire spectrum.
John, how do you see impact investing, and what do you think is driving the trend we're talking about?
Yeah. Thanks, Alan. And first of all, I want to thank Dan and Michael for organizing this. It's a great opportunity to sit next to Amie, who was there when I began my journey in impact investing, when Amie, myself, Mitchell Strauss, and Barbara Brereton did the first OPIC social impact call for funds in Africa, which was one way that the Overseas Private Investment Corporation began to look at how we could do, at that time when I was there, impact investing. For us at Total Impact, we look at impact investing as a bit of a transition phase for investments that have a very high potential to make the world a better place. And some investments that have a high potential to make the world a better place also happen to have very clear, high potential for financial returns, and really don't need an investor who cares a lot about that other aspect. But there are a number of investments, either because they're in a frontier market, or because they're in a new sector, or because their customers tend to be people who have very little resources, tend to be poor people, or because they're in a market where there aren't clear history of exits, where purely commercial investors will have a tough time justifying going into those types of investments. It doesn't mean they're bad investments. In some cases, they're very good investments, and in fact, could easily outperform commercial
So you're not
investments.
chasing low returns.
We're not chasing low returns, but we are looking for things that don't fit with what I would say the mainstream commercial investor would put into their portfolio. We are looking into the private side, private equity and private debt. We don't operate with listed investments. And we're looking for things that have that potential to make an extraordinary social impact, and because they have the potential to scale, to make a very high, have a very high financial impact. Now, sometimes that high financial impact might be on a risk-adjusted basis relatively low in absolute terms. But relative to the alternatives, we're looking for things that can perform well and also make a big difference.
And we want to come back to a number of the themes that the two of you have already brought up, including the theme of scale and the trade-off between return and impact. But first, David, why don't you talk about how you're looking at this?
Yeah, sure. Daniel, do we have that slide available? Yes, lots of legal qualifications.
That's not there. There's something.
It's a real joy working in a heavily regulated industry. So I just thought I'd bring this along. I was IFC's representative on the G8 working group on impact investing. And that was a very interesting experience. It was a wee bit like, well, I found it a wee bit like being in the Tower of Babel. You had different people from different backgrounds all viewing impact as a different thing. So you had people from a philanthropic background seeing it one way, people from a development finance background seeing it another way, people from a commercial background seeing it another way. And everybody, in my view, was just talking past each other. And there's a lot of mutual incomprehension. So I thought, okay, let's try and put down what everyone's talking about in some sort of chart that shows some sort of continuity. And maybe then we can have a conversation where we each understand each other. So this is based on a chart that I drew up for that working group. And effectively, if you start on the left-hand side, you've got philanthropy. And you're moving across from there through what I'd consider to be more efficient philanthropy. So you're going from things that are not sustainable to things that are sustainable. And then eventually you hit the space where the DFIs work, where things are not only sustainable, but they're getting scalable. And then as you move past where the DFIs are, you've got scalability, but you have a falling off in what the DFIs would call development impact or development outcome. So you're moving from what would be high impact spaces into low impact spaces, still with scalability. So maybe just look at the different boxes. You know, philanthropy on the left, obviously huge impact. I haven't put an impact number there because it's not sustainable. You've got to give grants for this. So this is grant territory. Now, a lot of people have got tired of giving grants for the same thing. So for example, if I'm interested in providing potable water to villages in West Africa, and I provide 100,000 a year in grants, some wells get dug, every 2 years the wells collapse because they're not being maintained, I give the same 100,000 again. After a while I get bored. So I want to find a more sustainable way of doing this. So what a lot of people have come up with in the last 10 years or so are models that look a little bit like private equity structures. You're putting 100,000 capital into a very small company, little small local well drilling maintenance company. It can service 20 villages. It's going to be sustainable so you don't have to put the money in again. So from a philanthropic perspective, this is pretty exciting. This is a much better model of philanthropy. That company's too small to really give a proper return on any third-party capital. So it's sustainable, but your returns are fairly minimal. Also, it's pretty small scale. The number of people you're affecting is quite small. So where can you go from there? Well, if you go up the scalability chart, and this gets you into where my team in IFC was operating, and I think where Bert's also operating in some of his funds, you get into a space where, say like Sierra Leone, you want to do something in Sierra Leone. You can't really take fully fledged private equity to Sierra Leone. Maybe in a 4-year investment period, you'd find 2 deals that scale the way you think they should, and the other 8 aren't going to. So you're really having to deal with much smaller companies that, for whatever reason, have some cap on their scalability. So you need a different model to deal with that. And there's models you can use. IFC was adapting a model from business partners in South Africa. So to get into Sierra Leone, you can use that model. Your return is not so high because these things aren't so scalable. Likewise, the total number of jobs you create, the total number of hospital beds that come out of it, the total number of people affected is smaller because you're in a smaller area. But if you want Sierra Leone, that's what you can do. Then if you just want to generally create impact, so you're generally operating in a low-income population, you're generally facing the environmental space, you want the biggest number of jobs possible, you want the biggest carbon reduction possible, you want the most hospital beds possible, you want to go after scalability, you want to go after very fast-growing smaller and mid-cap companies, in my experience. So there's data on the IFC website. We analyzed the portfolio, the funds portfolio, and if you look between the box that's called lower returns and specific impact and the box that's called commercial returns and significant impact, that analysis showed that the growth equity funds that were in that commercial return box were creating 10 times the number of jobs per company, and that's a proxy for anything else, I think, than the ones in the lower return box. They were doing it at half the invested capital per job, and they were returning high teens, 20s in terms of financial return. The ones in the box where we're trying to get into Sierra Leone, a tenth of the jobs, they're returning about 4 to 6%, but you're getting it in Sierra Leone. So it's a trade-off. Do you want your impacts, your outcomes to be general? Does that satisfy your need? Or do you want to be very specific? And I think the more specific you get, the more you have to make trade-offs between return and impact. And then if you move beyond that box that I've labeled commercial returns and significant impact, you're moving out of a high-impact space. You're moving into more a developed market. Yes, you've got scalability, but the number of low-income people you're affecting is tailing off.
But so are you trying to operate at that sweet spot in the middle?
Well, now this is the thing. What that chart is saying, it's not saying everyone should be in that sweet spot at all.
Because you'd miss a lot of geographies, you'd miss a lot of problems.
What that chart is saying is that you've got alternatives. And the real key thing is for everybody to understand what their impact objective is, what their return objective is, and line themselves up against the proper space. So if I'm a very large pension fund and my primary goal is meeting the liabilities of the pension fund, but I would like some impact, I probably have to shift into that commercial return space because I can't afford to give up return.
Right.
Now, for me personally...
But there is even for you an opportunity here
now,
to have impact.
For me personally, I need part of my managed money managed commercially, but then I've got another pot of money that I'd like to do something philanthropic with. So I find quite a few of the funds in that low return space really quite interesting from a personal perspective, but I'm going to have to take a cut in return to get there.
And does your firm operate at various parts of the spectrum, or?
No.
Yes. You have to operate in the sweet spot.
Because it comes from the client base. The client base, by and large, has a fiduciary mandate. I was a trustee of the World Bank Pension Fund, and you saw it very clearly there. If that pension fund becomes underfunded, the World Bank has to make a transfer.
You can't mess around.
The IDA countries suffer.
Let
There's no free lunch.
say that there is a case, for a financial case, for investing on that slope, which is you are going to, if you invest in a company in Sierra Leone, your competition is going to be less. You have a lot of other challenges. So and I won't argue that investing in a company in Sierra Leone and investing in a company in China is going to give you in the near term the same type of returns. But in the long term, if you can build a successful model that works in Sierra Leone, then you have the ability to scale that throughout West Africa. You have the potential to have a long-term return that is going to be...
So it's a time horizon
issue. It's a time horizon issue.
It's also a bit of an uncertainty. I think it's a terrifically elegant way of putting it out. And David has got vast amount of experience, particularly on the top down, looking at the world. I think it's terrific. What I know is that we can't always predict 10 years in advance whether a country is going to do fantastically. And in many of our investors, for example, they may want to take where we do a lot of our impact is in post-conflict countries or in very underserved markets where, initially the appetite of the markets, other people are not there. Let me back up a little bit.
Yeah, do back up, because I think the SEAF story is an interesting one, particularly coming out of a traditional philanthropic organization.
Correct, yeah.
It didn't quite understand what the hell you were trying to do.
Well, back in 1989, I think where we came under this, partly a little bit of what our personal mission is. I don't know where Amie is as well, John, David. And then from what we were finding in terms of people who wanted to share our utility function, our ride, what we saw was an enormous inequality in 1989 in the nations that were emerging from former socialism, former command socialism in Eastern Europe. What we saw is that there was a lot of uncertainties in these markets, and conventional money wanted to stay back and understand what those risks were. At the same time, there was a very present need. There were people who were jobless. They used to be in a cocoon of badly paid but relatively secure life, and now there was unemployment in the 25, 35% levels. So what Tom and I wanted to do at that stage was to say, well, how can we make an impact? How we can bring the powerful forces of capitalism, but to do what actually nobody else was doing at that stage. And our chosen mechanism was the entrepreneur. We believe that the sustainable local entrepreneurs who have an interest in developing in their communities businesses that are sustainable. I mean, we don't want to do wells like David is saying, with great opportunity. If you don't have the people on the ground who got a clear path to growth, you're not going to have sustainable employment. You're not going to make a difference. You're not going to decentralize the economic power, what was formerly a very centralized and inefficient economic power. So after many, many years of distortions, we saw a huge opportunity. Now, it happened that was also a good economic bet. Now, we were hoping that would be the case, but you don't know. You don't know whether Poland is going to ultimately revert back into Russia, or you could look at Russia. Russia's had some difficulties. What we then saw is, well, if that worked in a transition from a bad government where there was inequality of opportunity, where there was a bad quality of life, and where we could find entrepreneurs who would make a difference over time, who needed risk capital and who also, frankly, needed a very active partner who was going to be able to unlock, if you will, the keys to what it required to compete in a very fragmented and very confusing model of Western capitalism. Many of them have never seen that in Bulgaria or in Kazakhstan, et cetera. What we found is that then there was conflict in other areas, whether it was Peru or whether it was Sri Lanka or there were, because governments were bad, like Bangladesh, huge amount of opportunity because no conventional capital was going to go in. And in fact, the conventional, if you look at those countries, there were not many scalable companies at that stage. There were a lot of SMEs. Today in Bangladesh, there's a vast amount of SMEs and a bunch of garment workers. You know, there really aren't very large companies that aren't owned by the state. So there are markets, there are particularly underserved markets where people's lives can be improved in a sustainable way by investing in open, honest, and ambitious entrepreneurs. And those are the ones that we target. Now, this is, I think, a very important thing to understand is that there's a huge variety of risk, and there's a huge variety of emotional appeals or that are involved in that. We've had a lot of investors who want us to do stuff only for climate change, and in markets that are not being touched. And of course, if what you want is climate change or anti-climate change, if you will, renewable energy, energy efficiency, then we look for scalable. Then we will try to say, how can we find technology in those markets that are not touched, underserved markets, that we can really, because the pollution in Delhi is now worse than it is in Beijing. I lived in Delhi. It's horrible at this time of the year. But that's the same for Bangladesh. It's the same for Sri Lanka. The same for Tanzania. How many 40 funds are in Kenya? How many funds are in Tanzania? One. I mean, you know, and that's us. So, you know, and why is that? Well, Tanzania is not, frankly, as good a government. On the other hand, what we bet on at the end of the day is, and this is why I'm getting back to this graph, you can't really know 10 years in advance, is Tanzania going to go great or is it going to go bad? What you can know is that the valuations are lower and that you have a very rich selection of entrepreneurs, because there's great entrepreneurs in every country. The real issue is, can you work with them in such a way that they can have sustainable growth, that they can make a measurable difference, and that's also important, in the lives of the people that they touch.
So you don't know where you'll end up on this chart.
Well, I think this is a great way of looking at the world, and I think that's where everybody is going to have to make a decision. I think what David is absolutely correct on is that when you talk to an investor, you need to say, are you prepared to take a lower return to get that specific impact?
Yeah.
But you don't know. Just the last thing, like in Georgia, the Millennium Challenge Corporation was asking us to invest in agribusiness in the regions. Now, most people can just about know that Tbilisi exists in Georgia. Very few people know anything else about Georgia. I see Stephanie here. She knows a lot about Georgia. So one of the questions there is, doing agribusiness in Poti or doing agribusiness in Rustavi, the whole world is not going to be there. But if your specific desire, as it was with the Millennium Challenge Corporation in talks with the government of Georgia, is to reach those people that are otherwise not touched, you may well be prepared to take a lower return. You hope that the return will be better than that, so your hurdle rate in the parlance of funds is lower. But I think it goes to the intentionality, it goes to what you as a fund manager, implementer, want to do. And for us, we have that additional screen as a 501c3 of making sure that our mission, which is underserved areas, sustainable employment, that is satisfied as well.
John.
Yeah, I think for us, and I think this follows a little bit into sort of the approach that Bert takes, we operate on that downward slope, but we intend to get to the plateau at the top. We don't look at anything that we believe will stay on that downward slope. We have to analyze why is it there, and do we believe that if it's because of the local government that there's enough that can change in that local government that'll move it that way? Do we believe that it's because the sector is undeveloped and that sector will develop? But we believe we want to be in that downward slope because that's not where the commercial money is, but that's where the potential is to find something that can ultimately get to that plateau.
But there must be some sectors and there must be some geographies where it's clear you're never going to get there. And I wonder if you can talk a little more. I mean, we've talked about employment as a goal. We've talked about environment as a goal. But what issues are most tractable for impact investing? You can't solve all the world's problems, right? Which of the world's problems do you think this approach, where has it proven to be the most powerful?
I actually think you can address all of them. It's just you've got to find a different spot on the spectrum. So if you're after climate, then there's very good investments in the developed markets. You can pursue investments in the US that are new technology focused on cleaner technology, fuel
That
efficiency.
aren't getting sufficient commercial attention?
But that's not the point. See, this is where I'm just interested in the outcomes. And this comes from 15 years managing the funds portfolio at IFC. I'm not so concerned about the inputs, and intent is an input. I care about the outputs at the end of the day. So if I find a business model that's going to remediate a huge amount of carbon, and the guy's prepared to adopt an environmental social governance management system, so I know he's not going to do something weird in the meantime while he's doing it. I don't care if he has intent or not.
So you never say we're not going to do that investment because some more commercial and focused entity will.
No,
you don't do that, which is obviously common in more philanthropic conversations.
Right.
Well, I would argue even in non-philanthropic, we do ask that question.
You do.
And part of the reason is because we also have to look at where our core competencies are. And we can't compete with Morgan Stanley to provide financing for something that can attract, pension fund institutional capital.
So you will screen something out and say, we're not going to do this because somebody else will.
Someone else will, and probably someone else will do better than us on that. But here's something that we can do well that fits with what.
Whereas, John, you're just saying if it has the impact, and if we can have the impact, we'll do it.
Yeah, I mean, and yes. Also, we're prepared to go somewhere, I think, a little into your territory. I mean, if you go into an emerging market that looks like it's got the right conditions, and you think you can find a competent partner to work with, I mean, we're quite happy to back first-time
Because
funds.
it does make me wonder if these.
But it's just because our focus is what's the likely outcome. So if that's your filter, then there's a whole range of things you're prepared to do.
But the likely outcome has to, at some level, be informed by the intention, whether the intention in terms of the targeted investment policy. I mean, if the investment policy, for example, is climate change friendly investments, then certainly if the intent is to try to deploy, could be technology that's developed in the US, could be technology developed in India, it could be to say, look, where am I going to have the biggest impact? Well, what funds or what people can help me implement that technology in in the countries that have got the biggest amount of carbon atoms to be offset. One of the problems I see in Palo Alto is there's probably a couple of stray carbon atoms, but a lot of fantastic technology there has to go to Belgrade or has to go to Chengdu or has to go to Dhaka to be really implemented.
But that's where you find the guys who can take that stuff to
Right,
Asia.
yeah. But that's an intent. All I'm just saying, that's an intent.
I mean, I wonder if over time these distinctions are going to disappear. I mean, people want to have. We're talking about people who want to get a return on their money, and they want to have an impact on the world. And some may prioritize more return, and some may prioritize more impact.
Correct.
But almost everybody wants some combination of the two.
Right, and I think from our lens, what we've seen is that it is about the outcomes and being able to measure the outcomes, but it's more about the financial return and the soundness of the team, the strategy, and the opportunity, and that team able to capture that value and create the opportunity. So for us, when we screen for ESG and we think about what David has outlined as where the opportunity sits, we'll see there are market rate return opportunities and there are concessionary rate opportunities, and they have a distinction, and that could be driven by the geography, it could be driven by the asset class, and it could be driven by the sector.
Right.
And so we steer our clients and help them navigate. If you want to achieve X, Y, and Z, here's what your opportunities look like across asset classes, and this is where you'll have to make sacrifices. And this is where we would look to see if we could partner with other development institutions or other institutions to make the concessionary opportunity seem less risky so that they're willing to put more capital behind it, even though the rate of return would be lower. Whereas the more market-oriented opportunities are just sound investment opportunities like you would make in a more conventional allocation. It just has this added layer that we would measure and see the outcomes and measure the performance on a similar metric.
I don't disagree with what you're saying to me, but I would hate for the message to come out of this conference that there's a trade-off always between return and impact. I think there are instances where that is the case, but there are a lot of places where that's not the case. Now, in a 10-year time frame or a 5-year time frame, might you always hit the same benchmarks? No, not necessarily. Sometimes you have to take a different perspective on what your financial return is going to look like. But I think there's a large set of opportunities that have very strong impact, where you can go into it with the intent of having impact, where you are on that downward slope, so you're not where all the commercial money is, but where at the end of the day you can wind up with a.
But the probability may be different. The risk.
I think the risk.
The risk-adjusted return may be different.
Well, no, I would argue you can be there at the same risk-adjusted rate of return. It's just you may be taking more risk, and it'll take a little bit more time for you to get a return. I mean, there are on the tails, it'll be a little different. So I don't see a lot of impact investing unicorns. There may be some.
I think even that. I mean, it depends on what you're doing. If you're doing debt, if you're doing specific projects, if you're doing equity. I mean, equity is a longer-term hold. And so when you're talking about emerging markets, and I have to say, what we're talking about today is emerging markets. There's a vast amount of interest in impact investment in the United States or in Alabama or in Western Alabama. I mean, we're not talking about that. All of us have emerging market kind of backgrounds, and that's what I think we play. But what I would say is in that context, when we talk about a Columbia Agribusiness Fund, or when we talk about Zimbabwe, there has to be a macroeconomic case why within the 5 to 10 years we would expect to perform well there as well as make that impact.
Because if there isn't, it won't sustain.
That's the point. For us,
the point is sustainability.
Sustainability. So there is a screen. What I'm only making a difference, I advised a hedge fund for a while. Those guys could move money in and out because they were going for public equity, okay, reasonably public equity. Sometimes it wasn't as in and out as they like, if Argentina or whatever. But if you're talking about private equity, you have got to talk about predicting when the macroeconomic conditions in that country are going to improve. That's the rising tide. And you've got to find the best entrepreneurs who are able to implement what you're looking to do, whether it's a sector-specific focus, if it's an opportunistic focus, you're just doing employment as well as returns. I think we make bets, and sometimes those bets have to be very well understood. Uzbekistan turned out to be a bad bet. Karimov, we thought at the time we invested was not going to be there forever. It turns out that he is there forever. And whereas if you're looking at Romania, we got into Romania at a time everyone thought was horrible, and it turned out to be the best 8-9 years of Romania's life. Luckily, we sold out before Romania went back to its normal. But the issue, there has to be a macroeconomic understanding. What's the policy environment change going to be? What are the demographics that are likely to happen? What are the opportunities? And then, because, and partly it goes back to Dave. What David was saying is, if you can't scale, if you can't be sustainable, if you can't achieve something lasting, no one else is going to pay us for it. We can't get the money back to the investors, and most investors are going to, after a while, say, this reminds me a lot of those wells in South Sudan I keep
But
talking about.
are all four of you in agreement on that? Is scalability critical to the success of what you're trying to do?
I think if you want a commercial return, scalability is key. If you're a mission-driven investor, say, you want to create jobs in Detroit, you've got a very narrow focus. Then you're putting a lid on scalability. You're accepting you can't scale to go there. But if you want a fully commercial return, yes.
I mean,
I was just, sorry, one thing I would add is, I completely agree with that. I think there's also scalability at the model level. So if you think about low SME financing or agricultural supply chain financing, there's a certain rate of return that you can make out of some of the endeavors that exist in the market. There, it's not necessarily scaling the individual borrower, but scaling the model that deploys that capital that could get to a much higher rate of return, because you could think about structure and bringing in concessionary capital that would de-risk it or make it a little bit more appropriate for a more.
I also think it depends, going back to the conversations with the investors. Everyone, all things being equal, even if you're in Sierra Leone, you would prefer to be as scalable in Sierra Leone as you will. But if you then look at it in absolute terms over what the scalability could be if you were investing in China or India or larger places, obviously you're not. Scalability, therefore, is something that is relative to the sector or to the specific impact that you're trying to define. One thing I would want to say, that what we're also seeing a lot more, though, is that with social media, and you identified a lot of the big issues. We're seeing more and more corporations who are trying to get on the intent side, or at least on the I would like to do something good side that could be colored good, because of the fear that look at Danone, we deal with Danone in Colombia and some other places. If Danone, global organization, is involved in milk powder or bad yogurt or whatever else in Chad, and some kids die in the school, it's all over the internet, and it's going to completely dramatically affect the stock price of Danone. Housewives are no longer going to be willing to pay 20% more for a Danone yogurt in the supermarket. There's lots of things that come on. So they are trying to get ahead of this, along the lines that you're saying, in a way that says, even if I'm not going to get a super return, I want a nice story. I want, and what am I doing? I'm building up an armory of good stories, which insulate me to some extent.
I think it goes deeper than that. I mean, I think more and more, the negative externalities that corporations create are going to be reimposed back on them, and they're going to be expected to deal with those things, either because the governments are going to require it, or because the court of public opinion is going to require it, or their shareholders. And in that case, they need to think about how they can make investments that. So, for instance, if you have a company that uses a tremendous amount of water, and that's in a drought-stricken area like California, taking water out of the public sphere, they're going to have to think about how they solve that problem, and that may be through investments in water conservation, water creation technology.
But this is why what Dan was saying earlier, if you're talking about 10 years ago, it'd be 10, 15 people in a side room in the conference. And today, I think that the social media, the democratization of information, and therefore the rapid judgment that people make upon the bona fides, if not the intent, of the actors that are involved, whether that's governments. A lot of governments now want to be on the side of climate change. How do I express that and yet still get my money back? There's a number of European governments, for example.
So let me get, because all four of you, and I'm going to open it up to questions in just a minute, because there are a lot of people out there who I know are very interested in this and would have questions. But let me ask you all four of you are in this, you've been in it for some time. Can you talk about, if you think about the total pool of capital that's trying to operate on this impact spectrum somewhere, how much bigger is it today than it was 10 years from now, or 10 years ago, and what will it look like 10 years from now?
Well, you can see that just in the number of signatories to the UNPRI. I mean, if you go back 10 years ago, I mean, my figures will be a bit off here, but approximately it had 100 signatories and, I don't know, a few billion of assets behind it. And now it's something like 1,200 signatories and 40 trillion of assets.
This is the
United Nations Principles for Responsible Investing. So there's definitely a growing pool of capital.
And do you expect that to continue?
Yes.
Now, what I would say, so in the what you call the SRI pool, the negative screen pool, the ESG focused pool, that's where the vast majority of that 40 trillion is.
So we're not going to buy companies that do, we're not going to make investments that are bad,
Now-
that rip down.
Fossil fuels, alcohol.
In our world of sort of private impact investing, where we're focused on companies that have a proactively approach to do something good, the numbers are much, much smaller. It's more like $60 to $70 billion today that has been identified as.
But how about the growth rate?
So it's been growing linearly, about 10 billion a year. I think the goal, and where I think we're going to, is to get to a point where it starts to grow geometrically. The challenge is not the capital. The capital is out there. The challenge is finding opportunities that are investable and scalable. And that's where I think a big part of the effort has to go into if we're going to see that geometric growth.
I would agree with that. I think in 10 years from now, hopefully the conversation shifts that this is just the normal practice, and the other sort of, at least in the public sphere, the other subset we've proven that an ESG-focused strategy outperforms all benchmarks, and then the private markets, the data points start to show an even greater quantity.
Do you really think that's going to happen, that ESG investments will outperform all benchmarks?
Oh, yeah.
I think it'd be saying that it's already been shown to do that. I mean, I think there is a very strong case in general for proper ESG, especially in a world, like I said, where companies have to take in their negative externalities. The long-term risk mitigation you have from good, solid ESG is very valuable.
Do does everyone know do we define ESG for everyone? I'm not doing my job as a moderator here, but.
Environmental, social, and governance standards.
Well, I think what John is saying is that there is the downside risk of not taking that into account, which, I don't know whether you look at that as a risk-adjusted return. I still believe, there's a lot of smart people in New York and Zurich who, I don't think they would have, had they known or had they really expected that impact investments are going to outperform the normal investments, they would say, oh, gee, I could have had a V8. I think there's a lot of those people who have not come to it. But I think in the long run, for sure, the world and the democratization of information, the importance of, I think, even addressing some of the issues like good capitalism, bad capitalism, means that that's a powerful driver. I think as long as the interest rates are low, I think that we will outperform those. I've been on this a couple of cycles, some of the people here have as well. When the Dow was performing at 30% up a year, I can tell you it was very hard to raise money for me.
It's harder to raise money when
risk-adjusted basis, I was not going to be able to find a lot of takers.
Right.
But so when you're now talking about negative rates in Europe, it's the only thing I would say, and I wonder what you guys say, is I see a lot of demand for fixed income, and much less demand for equity. And part of that has to go for the model, the 2 and 20, the buyout model that's imported from Silicon Valley, probably is not the right model for Bangladesh. There's a big difference there.
You need more equity.
Well, or you need a longer sort of time horizon. You may move to a permanent capital vehicle. You may move to various other ways that you ought to give people liquidity. Because I think the exit uncertainty in the emerging markets, look at the dollar having gone up 40% from most of our
It needs to be risk capital.
Absolutely.
No, I was just going to say that point that, especially for emerging market exposure, the bias is towards more credit.
And what about on the supply side? Is there any, do you see any limit to the investment opportunities?
No, I think there's a massive limit, and that's the limit that we have to figure out how to break through. There's no limit in ways to make the world a better place.
Yeah.
There's no limit in people who have business plans on how to do that profitably. There's a large limit in ones who've been able to show a track record that they've been able to succeed and have a path towards.
It's managerial experience.
And
It's investment experience.
and managerial experience.
When you
and
say investment
business
experience, so
model
you're
track
talking
record.
about the person on the ground. Yeah.
And those that can allocate effectively to those entrepreneurs.
So both.
Yeah, no, there's definitely a limit. If you sort of use some sort of filter system to go down and say, okay, what are all the good investments in a market? Now what are all the investments that are not only good, but are going to have impact?
Right.
It suddenly shrinks quite a lot.
Yes.
So if all the capital out there suddenly decides it needs impact as an overlay on everything, no, you can't. It's always going to have to be, I think, part of someone's portfolio, not the total of the portfolio.
And so what needs to happen to scale to scale the supply?
Well,
I don't think we're at the limits yet. I mean, quite honestly, there's just a ton of good stuff to do. I think it depends a little bit upon the uncertainty of many people dipping into impact. I think that it's a longer sell. It's a longer conversation. I think it's also, and this is the only thing I'd quibble again a little bit with David there. I mean, fantastic analysis. I just think the world is a lot more uncertain than that. When I go around to people today, I don't think anybody can say which countries are going to be great in 10 years. I don't even think that you can say technologies. You know, cable television is going to be great. Well, no, cable television could be completely set aside. You know, telecom, you know, fixed line versus mobile versus 3G, 4G. All of those things are all over the place. We're going to see a huge change in telecom as everyone moves to 4G. All those people like Celtel that made money on 3G, are they going to be able to come up? Many of them, yes. Many of them, no.
And does it? And I will open it up because I want to get the audience in. But just one more question. I don't know how many of you watched the show Silicon Valley on HBO. It was a wonderful show. One of the early sessions, they had this sort of TechCrunch Disrupt conference where all the entrepreneurs stood up and said, you know, I'm inventing something that's going to compress your data to 1/3 the size, and I'm going to change the world. Yeah. And everybody ended their presentation, and I'm going to change the world. How important are the semantic distinctions here? If everything is changing the world, does it make it harder to get people to focus on the kind of impact that the four of you are focused on?
I think it's the intentionality of a fund manager or a thesis or a strategy is where we spend a lot of our time debating as a team as to who to determine would qualify within our realm versus would just qualify in a more conventional portfolio. And I think now that we're in the walls of Goldman and their asset management business and in the alternative investment group, that's doing manager selection as the core competency. We're starting to bridge that gap, and I'd be curious to hear what David thinks. There are a lot of fund managers, there are a lot of people deploying capital in the market today that don't self-identify as an ESG or impact manager, but their work and their investment has definitely risen to the top if you were to benchmark it.
I mean, this was a huge conversation at our offices when we were doing the Change the World impact. How important is intentionality? We were talking about that in the green room earlier, David. I mean, does it matter what your intention is if you have the impact?
It's a dialogue. It's a dialogue. It depends on what the investors that you're taking. If your investors have a clear ERISA standard, you're going to start with return, and then you're going to go on what you're going to do with that money, or what you're not going to do with that money is probably the first conversation, and what you are going to do is the second. But if you're talking with family offices, you know, I think all the democratization of this, fragmentation of this, requires more communication, and this is actually where I believe screeners like Imprint will provide more and more of a role, because ultimately someone has to be able to trust and communicate what you're going to get.
What is your goal, and do we have something that matches your goal?
Because it's an alignment of interest and it's a communication of what it is you're doing, because otherwise, you know, then it's going to be, wait a minute, I put money in you and I expected to make a big return. I mean, at some level, this is the legality. This is the one thing I will say that's going to limit a little bit the supply is regulation is massive. I mean, we're SEC registered. It has added a lot of cost, a lot of difficulties in terms of even getting our data out in the way that we know can pass whatever vague guidelines the SEC gives. So it's I think we could not have started up like we did in 1989 in today's environment. There will be a lot of people who will try to start up and will not be able to get to a certain level. At the same time, the demand for information, the demand for quality, the demand for professionalism is there. And when you're talking about dealing with a Meteor Foundation, I mean, these guys, they made money in a very professional way. They expect their impact investors to make money.
Talk about intentionality.
I'm not such a fan of intentionality, simply because I'm focused on what the outcomes are going to be. So as far as I'm concerned, the outcomes in any one of these spaces are driven by the underlying business model and the competence with which that business model is applied. So if I've got someone who is competent to apply it, if they're in a high impact space, if in my case, I'm looking at people who are doing growth equity because that's the most scalable thing, if I've got ESG, you've got those four things together, I think I'm going to get 95% of the impact, 95% of anything I'm going to get. Now, if I then have two fund managers who meet all those requirements, and one has intent and one doesn't.
And
I'll prefer the
one of
with
them just
intent.
wants to get rich.
No, but I think a lot of the stuff is driven by the underlying business model and the competence with which it's applied. So, as I was saying, if I get two managers who meet all those standards, but one has intent and one doesn't, I'll prefer the guy with intent, because he's going to go the extra mile. He's going to really make sure the labor conditions are good. He's really going to make sure that his factories are efficient and not polluting. He'll go the extra mile. But if he's short on one of those other factors, he's not going anywhere.
See, where I think the separation between all those folks in that scene you talked about in Silicon Valley, oh, we're going to change the world, and the type of folks we deal with, have a very clear metric for impact. And they enunciate it at the beginning, and they have a mechanism for tracking
And that's important.
And that's important for the people we try and get into those investments, because they're looking for that as well. And by declaring what their impact is going to be in a very clear, measurable way, I think by definition they have to come up with some intent. And I think that's where the intention for us, becomes important.
Let's open it up. Do we have microphones? Okay. Lots of questions. So let's start right here, then right here, and then right there.
Jeff Liebert from Gazelle Finance. We're an SME impact investment fund. How you guys doing? And we're supported by some DFIs in Europe, and we're hopefully going to be closing out with OPIC soon. And when Alan said there's a lot of money out there, and it's not getting deployed, and then I heard you guys talking about, well, there's not enough people to receive the money, and then the fixed income comment that Amie said, and I think this is something that I'm really struggling with, is that we're trying to match equity, is what SMEs need. If we're talking the missing middle, which is sort of a sexy term in the impact space. And the people that want to give us money is short-term money, and it's matching the long-term money, right, that's needed in the markets with the capital markets. And you're telling me that there's lots of money out there. So what I'm wondering about is what is the role, let's just say Morgan Stanley, Goldman Sachs, whoever, to really get the scale that we actually need, to not be so fragmented, right? Because I think what we're seeing in the market from the supply side of getting money, it's highly fragmented. On the equity side, debt, you can find debt. There's plenty of debt out there. Short-term debt, sub 5 years. But you want 10-year money, it's what you really need in these markets. Really, really tough. And so what I'm curious about is how do we get the $1 billion to go after the missing middle that is 10-year patient money? And there's a real mismatch from the supply side and the demand side in the frontier markets.
In my mind, this is part of the function of this still being an early sector, and why we need people who are self-identified impact investors to provide, like the DFIs that you mentioned, to provide that longer-term patient capital. Ultimately, when we get enough volume, financial engineers can figure out how to take a pool of assets and cut it up in a way that you can provide short-term liquid money for folks who are interested in liquidity, and longer-term money for the folks who are pension funds or whatnot who need the longer term. I mean, we happen to be working with one particular fund, which is a long-term investor, but it has enough, it's structured in a way that it provides its investors with an annual redemption factor. So they can redeem with a year's notice. So it tries to match that requirement on one side for one type of capital with the supply that's on the other. And I do agree that while there's lots of capital out there, there is a constraining factor between the flavors of capital and what's required on the ground.
Yeah, SEAF from the beginning was focused on equity.
Right, and I mean, as Stephanie knows, and Jeff as well, I mean, I think it remains difficult. I think impact, a big part of impact is it's fragmented, and then the question becomes, if you're regulated, how do you get to that? You can't do a general solicitation. You can't put an ad in the back of, Impact Investor magazine. I mean, there has to be, so what it requires is you deal with your reputation. You have to deal with a compelling vision, and you have to try to find out, which is not easy, who cares about the vision that you have, the specific vision. Because if you go to SOCAP, I mean, SOCAP out in California, most of you are aware of, that's the annual meeting of social capital. It was massive. But it's everything from locavores to education by online to wherever. And what you have to try to find out is what is the vision that you have for impact, and of course your mission and the genuine commitment. I think that's what David is looking at, why intent matters at some level. versus, at the end of the day, investors who are going to have an expectation that they receive some return.
There's not an app for that?
Not
app
yet.
that matches
The problem, I'm sure you'll let us know. The last thing, just to say, David, go into this. I really think that there is a challenge on equity, but part of that is just the reality that in an uncertain environment, and particularly with the model, the 2 and 20 model, many investors have been burnt by that, even when times were better. If you're looking at the difficulty of getting exits of a lot of those funds today, I don't know anyone. If I was up with the SWED fund, everybody, is extending to 13 years, 15 years, whatever it is. So, there's what people are going to say is, I'd rather have fixed income, or I'd rather, if you're dealing with that bucket of risk. So we have some work to do in terms of providing
you
that.
a solution for that. I'm interested in how the permanent capital vehicle.
I have a solution to this permanent capital vehicle, and Anthos and a number of large social investment people are saying, and this goes into, we can't do everything, but one of the problems that many people have is can an exit actually damage the good that you've done? I mean, I think I would probably say no, but there are people who really do obsess about that. I think that the issue of growth, employment, sustainability, obviously if your companies are growing at 30% a year and still have a long way to go, particularly you're dealing with SMEs, sometimes that's, they're going to grow with a second derivative going positive, but that first derivative is not yet positive. So selling out to bigger people who then claim credit for all the hard work you did in trying to get these acorns to saplings or whatever it is, obviously it's a dispiriting kind of thing. I mean, David is talking about higher incremental at the higher levels, but somebody had to bring those companies to the level where those larger funds can invest in. So all of those things, I think, can be at some level solved with. But even a permanent capital vehicle, what we're doing in Bangladesh, we need to find out who are the people who want to invest in it. So we find people in Dubai who they love the fact that Bangladesh has grown 6% a year for the last 10 years, but there's no way to play it. There's no exchange traded fund that can give me exposure to Bangladesh. Or there's Bangladesh diaspora. I mean, when we talk about impact, diaspora is a whole part of that field as well.
David, you wanted to?
Yeah, I was just going to say the market is generally inefficient for you and for everybody. So you've got, frontier markets, first-time fund, smaller fund. So there's a lot of capital, say, in Europe, big pension funds, they've got an allocation to impact. Their minimum bite size is 100 million. So they might like what you're doing, but they can't invest because you're too small for their bite size. So that's a problem. The group that probably, and then there's a whole bunch of advisors and so on who might like what you're doing, but they don't do first-time funds. So I would think the most likely channel is the high net worth groups.
That's fragmented.
And it's very fragmented. And they all want something different.
Yeah.
I mean, they all want some particular impact generally. But there are various networks of them. I mean, I was at dinner with someone in Denver, a professor at the university there, who was running a sort of a local network for high worth people interested in impact. And there's a number of those networks that if you can plug into, I would guess is your best chance.
Amie?
No, I was just going to say, when you start looking at more of the impact-oriented investors, from our experience at Imprint, they have a particular desire of how they would like to see their capital deployed, and it is a matching game. And that was the hardest component of the job. Once you get into some of the larger scale investors, you can start leading with a theme or an idea, but with the very niche impact investors in the high net worths, it really is a matching game.
Right here in the front row, and then we're going to go over here.
Hi, Chris McRae, Norman McRae Foundation. I was wondering if we could go to some, specific practical context. So one which would interest me would be connecting education to sustainable youth livelihoods. Has the sector achieved a great example in that area?
We haven't talked about education at all. Has anyone done much in that area?
Yeah. I mean, one thing we didn't talk about is why you had asked the question, are there particular sectors? And we'd say, well, every sector has a potential, and I think that's true, but there are particular sectors that have attracted a lot of interest. Health is one, education is another, and I think there is real value in the essential services, because essential services have people need those no matter how you cut it, and so there's always going to be a market for those types of things. There's one of the big impact success stories today, although it's still not played out, is Bridges Academies in East Africa, which is growing by leaps and bounds, and actually has sort of, on the capital side, has sort of moved that point from where they originally started with purely impact money And now they've actually attracted, I believe, NEA out of Silicon Valley, which is a pure commercial investment.
Yeah.
And I think a few other commercial investors as well. So, education has been an area that I think, and there's a lot that's happening in ed tech that I think has real opportunity, using sort of the smartphones or even the non-smartphones to deliver content to folks who otherwise don't have access to it.
Who has the microphone right here? Introduce yourself, please.
Hi, I'm Deepti Tanuku. I'm with JPIGO, which is a global health NGO affiliated with Johns Hopkins. My question is, I represent the perspective of a global health NGO, a development expert with a not insignificant operating budget, a very large global footprint, a lot of expertise in the countries that I believe are looking at. And so painting basically the picture of enthusiasm, we're on board, this is exciting, this is what we want to do, but have found one stumbling block over and over, and you alluded to at the beginning, which is terminology, and just trying to speak the same language even when the exact same word is being used. So that forms the basis of my question, which is, how do you really define impact, or how far are you going in that definition? Because in the development sector, our definitions are incredibly nuanced, researched, detailed. Do you have people on your sides that are trying to educate yourself in that perspective, or is it just as good as an example of health, number of lives saved, or disability-adjusted life years? Thanks.
Well, from our side, and it's a great question, and it's obviously not one that we can answer in 2 minutes. I mean, you've spent a lot of time on it as well. I think what has to happen is that first we set out what we mean by impact, and then that's kind of one circle. And then we talk with investors who have perhaps a slightly different circle, but they have to intersect. They want to understand what motivates us, and then we want to say, well, is there a business proposition that we can invest in, depending upon what the demand expectations of the money are? And then you get to metrics, and then the metrics become very important. Is a job in Western Georgia worth more than a job in Tbilisi? Is carbon sequestered in Dhaka more valuable than carbon sequestered in Phoenix? I mean, there's a certain degree to which people are not going to come, and I think I finally made the realization, I suppose, that the thing about impact, there is a discussion of intentionality, even if at the end of the day you're still backing business, because otherwise people wouldn't call it impact, and their intent may well be different than your intent. So I think it's extremely useful to look at that. For example, one issue is, do you care about scalability? I think it's a massively important question that people need to look at. But then beyond that, it's not that it's exclusive. It can be, I care about the best impact possible in Eastern Macedonia because that's the country I came from, right? I mean, so what we have to do is then who can implement that, who can do that on an efficient basis, and who can do that in a way that you can trust and rely, because if they're your implementers or if they're your partners. One thing I will say, this whole movement coincides with conventional development budgets being slashed, particularly in Europe. And so what you're seeing in Europe is a lot of people who want reimbursable grants or who want their money back at some level. Their return expectations may be very little, but they want to achieve what they used to achieve through grants, now through people who are able. So that the whole definition there has to change, and that's important for NGOs, because if the NGOs can now leverage the trust in the network and the footprint that they have already established, can they work together with a provider of capital to make it more efficient for the provider of capital to achieve that? Those are all conversations you have to have. They're all extremely, I guess, idiosyncratic, and that takes a lot of the time and frustration.
We talked about the fact that there is a bit of a dearth of opportunities to invest where there is a track record of execution on the ground. And I believe groups like JPIGO have a huge portfolio of opportunities that they've shown can have a track record on the ground. They've been financed with grants. So there's a lot of work to turn those into opportunities that can be investment. And one issue is the way that they look at impact. And I think, the donor community, when you're getting a grant, you'd allocate a whole lot of money to do a random control trial and to do all sorts of things to figure out exactly what impact you had and what was the attribution to you versus other things. You can't burden a small enterprise with that. You have to have a very clear metric, and you have to accept, like everything else we do, that there's certain margins of error around it. And you have to say, look, if our project is designed to try and get access to patients' access to primary care, how many patients got primary care? That's something we can count. And that's fundamental to knowing if our business is doing well. And let's count that. Let's not then try and do a whole random control trial.
So that transition is difficult.
I think it's extraordinarily difficult, but I think it's a huge opportunity if folks are willing to take that step.
So a question up here in front, and then a question there in the far back. I'll try and get to all of you, I promise. Who has the microphone?
Where is he? Over here.
Right here in the front. And then we're going to go way there in the back.
You're trying to make the microphone guy really
Yeah,
run back and forth.
I want Charles to get some.
Exercise.
You have your Fitbit on, Charles? It's not on.
Now,
There we go.
the pillar of current bank regulation is the credit risk-weighted capital requirements for banks. And credit risks is sort of nonsense because they already been cleared for by the banks with interest rates, premiums, and size of exposure. What do you think about the possibilities down the line of impact-weighted capital requirements for banks that will allow banks to leverage more when they have an impact than when they don't have an impact? Nowadays, they're allowed to leverage more when they lend to the safe than when they lend to the risky. So that creates a tremendous distortion. So if we are to distort, can we not think of distorting in this direction of something good? Do you believe the possibility of impact rating agencies?
Well, there is a group out there, HIT, that's trying to do that. There's a number of other rating agencies. You probably know a lot more. I can't imagine that the banks would ever do this. I mean, Basel III has completely screwed up SME lending. The government of Greece is obviously a safer bet than an SME, and so that's why there's zero reserve. I mean, I say that partially sarcastically because, and a lot of regulators are built in by governments who clearly want to borrow at a preferential rate versus business. I mean, I think a lot of corporations, I think you're seeing a lot of non-bank financial intermediaries being formed to get around that. And I think a lot of the banking model may really suffer a lot of issues. Are there rating agencies? There are. The problem with that is there one single perceived metric on impact? You get to the gin or the gears, and I think they've struggled violently to try to find something. At the end of the day, they come up with employment. I mean, it's not really all that amazing.
No, Amie.
No, I would say that the debate around rating agencies and having a unified way of measuring impact across everything is there's IRIS that gives you terminology, there's the B-Lab and Gears
Right.
that are trying to rate managers and trying to rate individual companies. They're trying to roll that up. Then you have an entire group of development institutions that have been measuring for decades now on an ESG front that also don't have a unified form of collecting all that data.
Right.
So there's a lot of data out there. I think it just comes down to your earlier question as to what is impact investing, and it comes down to what is the business model, what drives impact, what drives financial success, and then how does that investor want to see that success, and how are they measuring that outcome? So I don't know if there'll ever be a uniformed rating system because there's too many different ways in which one can achieve impact.
I think so.
Where's the microphone? Thank you. And
Hi.
then we'll come right here in the middle. 4 rows back, sorry guys.
Yeah, Dave Ramaswamy with Africa Agribusiness Magazine. There's no spreadsheet which survives first contact with rural African reality. So what have you learned from your investment failures in the impact space? And related to this, the civil society sector has corrupted, I know it's a strong word, a lot of African countries with free money. So how do you change mindsets into getting people thinking into the investment and return-oriented field, and also bridging the perception gap against the financial sector, which is seen as exploitative and predatory, especially in agriculture and environment? Thank you.
So we invest in African agriculture, and our spreadsheets certainly have not survived the first touch with reality. That being said, we see the opportunity as fairly immense. It's again, food is essential. Africa has the largest amount of untapped arable land, and the world needs more and more food, and the opportunity to capitalize on that, I think, is real.
And labor.
Is real. Yeah, and labor as well. I think you bring up a very good point, which is the African ag sector has been heavily dominated by lots of aid programs. And so how do you sell, for instance, we invest in a tissue culture lab that sells tissue culture plants to small farmers in Rwanda. And if they're used to getting inputs for free, how do you sell them? And that's a challenge. But our biggest customer happens to be one of those same type of NGOs, the 1 Acre Fund. And the 1 Acre Fund provides farmers with inputs, but they provide them not for free, but as a loan that they take from their from the other side. And the 1 Acre Fund is primarily, almost entirely, donor grant financed. And so I think there's good interactions between the impact investment world and the donor world, and they're bad ones. And it's not a general rule that, oh, well, if you have donor money there, that's bad money, and that'll push out Gresham's law, push out good money. I think sometimes that's the case, but sometimes you can find a way to make those things complementary.
I think you also have to focus on the supply chain. I think donors have distorted so many parts of Africa that unless you have specific offtake and try to go up and down that chain, who people want more consistent quality inputs, or who want more or are willing to pay more regular in terms of getting sufficient supply to do the processing. I think they become closed loop kind of organizations, and we don't see how you can play Africa without, on agribusiness, we're in Tanzania, without having that specific supply chain focus. We'd love to expand it higher, but I think the donor distortion and the corruption in many cases on infrastructure as well make that difficult.
Right here, 4 rows back.
Good morning, ladies and gentlemen. Thank you so much for your presentation. My name is Rosemary Segero. I'm a president of a company called SIG. We were the first company to write a missing middle concept to the World Bank before the SDGs and what we are talking here now. So we are trying to invest into the rural areas where we want impact, because the rural areas in Africa, I come from Kenya, is where we have agriculture, is where we have resources, but many investors don't understand investing in the rural areas. So now that you've talked about this and with my company, I hope I'll talk to you so that you can invest in my company. So, yes. So what is the best? But you have a question. Yes. What is the best impact you have done in Africa, not in the rural area or in urban? What is the impact you have done, or what is it that can make an impact of development and growth in Africa, comparing to China, going to the rural area and investing there? So what is the impact?
Good. And could you just pass the mic 2 rows up? And you guys can fight over it. Africa, highest impact investment in Africa.
It's hard to dispute the CellTel comment, John. I think you made that comment, right? Here. Yeah, well, you may want to tell it.
Well, if I were to look at my experience in the Overseas Private Investment Corporation, we were looking at what was the most. Has it gone off, or is it?
To a dead battery? What's the
I think
issue?
our time limit is up.
We're up.
You've talked too much.
John, you
I'm
may
sorry.
have talked too much.
The technology has shut you down.
Here you go. Here goes the
The comment I was making.
Thank you.
The comment I was making was when we were in the back was that if in my mind, there's a difference between impact and impactful. At the Overseas Private Investment Corporation, everything we did, we sought to be impactful. Not everything would fit the definition that we've been talking about impact. If I were to look at one of the most impactful things we did, it was investing in funds that invested in CellTel. And if you look at what CellTel, along with MTN and a few others, did in terms of revolutionizing Africa, it was fantastic.
Amazing.
It's not necessarily an impact investment, but it's extraordinarily impactful. So I do think there are things you can do that have tremendous amount of impact at the outcome level that David's talking about that don't necessarily fit the types of things that we look at for impact. That being said, when I look at where I would put my money today to have an impact in Africa, it would be in ag, it would be in health, and it would be in education. Those are all very, very challenging places. So it may be that the CellTel stories around those will be told 20 years from now, not sort of not 5 years from now. And that's why you need impact investors, not purely commercial investors.
Okay. Should we let these guys have their microphone back?
Good morning. Eric Trachtenberg, Director of Food and Agriculture at McClarty Associates. What I wanted to do is I wanted to go back a little bit earlier and talk about the issue about deal flow. and how to find companies that are actually worth investing in. And one of the concerns is with aid agencies cutting back, with NGO money limited, with donor money limited, getting those companies ready for the impact investors to get involved. There seems to be a bit of a constraint, and I'm wondering if you have thoughts about how that deal flow that leads to the impact investor might be facilitated so that more companies can be invested in and start moving up the value chain. Thank you.
One of the things that we've been seeing is there's actually been an increase in incubators and innovator models that are spurring up everywhere. And there is a little bit of interest in accelerating businesses at that early stage. There's a new vehicle that's coming out that's seeding early stage seed managers. So taking the form of maybe an SME development agency that would have targeted that, now bringing more of a tech lens or a Silicon Valley approach and creating hubs in a lot of cities across the globe. And so that's one way that we're starting to see endeavors priming the pump with impact at its core, or tech
Sort
at
of
its
incubators.
core within each geography.
Yeah.
Just since we're in Africa, real quick, and I'll add Mima Nedeljkovic, Initiative Global Development. You know, we got the money, we got the markets, you've now found the entrepreneurs. The real key, I think, in the end, and I'd be interested in the question, how do you translate those three different languages so they understand each other and actually recognize that, in fact, their interests are aligned?
Yeah.
How do you do it? That's a very labor-intensive project front-end prep cost.
Correct. One of the things, you're absolutely right about that, and there's a lot of cultural discussion, communication, particularly in many countries that have never had equity capital. What is equity? And at the end of the 30 minutes or an hour of conversation, you've explained about equity, says, and so what's the interest rate? You know, you have that kind of conversation. What we have found, and what we've done now in 14 countries, in the reflows of some of our investments, we've formed these centers for entrepreneurship and executive development. Very important, trust is at the bottom of this, because many people are not listening because they're expecting that you're going to rip them off at some level, or they're trying to rip you off, and they're trying to understand how gullible you are, how much with the donors you've been, or whatever else. So what I would say to leverage that, we now have 35,000 entrepreneurs in 14 of our centers for entrepreneurship and executive development. They get practical coaching, they get networking, they go through business plan kind of contest, not anything that we as a fund manager could invest in. Part of this is fees driven. They have to pay fees to join. Some of it is local corporate sponsors who are trying to address the supply chain, if you will, for many of their countries. And part of it is still donors. So, but I think the good news is people are recognizing the difficulty. And if you want to scale up so that you can provide more products ultimately for the larger money, getting these entrepreneurs over the hump of this family businesses. There's a huge generational change in all these places. We're in Northern Africa in particular. Massive change in a place like Algeria. And great opportunity as a result, because people who've been overseas and come back, they do understand that making money isn't necessarily bad. They do understand that if you're going to bring risk capital in, you're going to have some negative controls and all that kind of issue. So I think we have one solution, and 35,000 entrepreneurs. We're certainly delighted that so many. On the other hand, 35,000 entrepreneurs in the world is what? It's water on a hot rock. There's a lot of. I think Endeavor has even less entrepreneurs, but they probably go deeper in. And we have two of our companies that have gone into Endeavor. They've done a fabulous job, because what they try to do is then bring consultants in, bring people at a higher level to bring them up. So you're absolutely right that it's a huge part of the ecosystem. That attention gets given in a way that will promote sustainable trust, that examples are going to be communicated with the democratization of information, et cetera. I do think that there are I think there's a couple of organizations out here, as I saw on the guest list, who also focus on entrepreneurs in that level. So yeah, that's going to be part of the ecosystem.
Okay, so we have time for one more question. I promised it to the guy way in the back, but there's a guy right here who has the microphone. So let's do two very quick questions. I apologize to everyone else. I've tried to do some geographic diversity here. You guys over here, though, have suffered because you're behind me. I apologize. But why don't you quickly ask your question and then get the mic back to the fellow in the far back of the room, and then we'll do quick answers and move to the next panel.
My name is Eric Bull. I'm with Development Finance International. We're an emerging market focused consulting firm here in DC. Can you talk a little bit about the role of domestic capital markets as a way to help achieve scale as well as sustainability?
We can do that. I mean, a number of what we've been trying to do, we've raised money from many of our funds, about half has been raised from local sources, but they tend to be pension funds or insurance companies like that. The actual capital markets in most of our countries, now we're not dealing with the super big ones, but even in China, when we were about to list a company a year ago there, the GEM, you can see the volatility. Most of these markets are not so well, you're talking about capital markets. I think the local institutional investors, they will be there, they will invest. Many of them are requiring to, particularly pension funds. But the exits on them, if you're looking at local capital markets, that has to be said has been disappointing.
Yeah,
You know,
I would say this is a huge opportunity.
Sorry? Well, local commercial financing is there, as I say, particularly the pools of savings that are there, whether they are pension funds, insurance companies in particular. I think that's typically who come in. And that is developing as countries realize that either there's an excess of debt. If you look at a lot of countries, there's way too much debt and not enough equity. Latin America is a great example, I think, of that. But if you're trying to move, a lot of the agencies have been trying to push us towards capital markets, and I think you're still going to get aggregation in places like London or Dubai rather than in Pakistan or in Bangladesh, just simply because the transparency, the level of depth in the market, the ability for people to manipulate those markets make it very scary.
But this is a really big opportunity because there are $2.6 trillion, I think that was when I last looked, there's probably more now, in pension funds in the developing world. And that money is basically locked up in government securities and real estate. And the opportunity to direct that into the type of sectors we're talking about is immense. And the great news about that is it takes away the currency risk, which is such a problem for our normal investors who are...
You want to add to that, Amie? It's the same point.
Yeah.
Okay, last question, quickly.
Thank you for the last question. My name is Mark Schleif from
It's
the
like
director.
winning the lottery. Congratulations.
It is. It is. That's right. I gladly trade in the 1.5 billion ticket chance to ask this question. My name is Mark Schleifer. I'm the director for Eurasia and South Asia at an organization called SEAF, the Center for International Private Enterprise. Actually, following up on Eric's question about deal flow and this discussion about domestic mobilization of domestic capital and the question about finding the entrepreneurs, I'm wondering if the panel could just say a few words about how the domestic business climate and the policy and the regulatory issues that affect the entrepreneurs in these countries plays out into the ability of the impact investing space to actually find the companies to go and invest in.
Oh, it plays out enormously. The deal flow, just talking emerging market, private company investment generally, if you went back to the 1990s even, and tried to execute some sort of impact investing strategy, you wouldn't find any partners to deal with. I mean, those countries were largely regulated or kleptocratic or whatever. The shift to market-based economies in the 90s has really opened the opportunity hugely. I mean, partly because it just enables businessmen to get going, it enables entrepreneurs to get going, but partly also because it flips the incentive structures. So, I mean, not to beat up on Nigeria, but if I'd been to, we've just made an investment there, but if I'd been to Nigeria in the 1990s trying to do this, and I turn up and I'm wearing a suit and I've clearly got a checkbook, somebody's incentive is more to take my check and run and not do anything because their ability to grow a company really isn't there. Well, now it is there. And so now they're really actively wanting partners. So, and in each of these countries, there's an increasing sort of clean space where you can find good commercial partners. It's free of corruption. The politicians don't have their fingers there. Maybe some sectors the politicians have their fingers in, but there's a lot they don't. And you really can find partners to work with. I think the next step in all this, I think there's two. One, the legal systems need big improvement. It's still the case that, well, you just don't think about it in the States or Europe. A functioning legal system means that I can bargain with you, I can work with you and not even know you. Because I've got a contract, and that contract I can enforce easily. I mean, that's exaggerating, but Whereas in a lot of these countries, the legal systems are so poor, you really have to know someone to the extent of maybe being related to them before you can work with them. Because you can't, the legal system's not going to support you.
Which is a limit on scalability.
Yeah, very much. So,
not a huge one, but it is a limit.
So I think there's been a huge improvement through shifting to more market-based, rules-based economies. The next step is probably improving the legal systems. And also the banking systems. The banking systems have come a long way, but they're still by and large asset-based lenders. So if you've got the type of company that doesn't have a whole lot of heavy assets, it's hard to get finance, which is good for deal flow for private equity people, but it's probably not good overall for the economy.
And the only thing I would add is that you're starting to see a lot of government agencies also creating their own innovation programs and doing matching programs where if they'll provide some capital and then they'll look to generate a matching capital from the private sector, which is demonstrating that they're really wanting more entrepreneurs to be locally based, locally sourced.
This has been a really, really great discussion, and clearly by the number of questions we didn't get to, we haven't covered everything, but we've covered a lot, and I thank all four of you for doing that.